Financial Health Study. My name is Kimberly Gartner, Senior Vice President, Strategic Partnerships at CFSI. I'm joined today by my colleague Eliza Gutman, Director at CFSI, and she was the lead for this important study. I'm also joined today by Denise Lienhard with American Express. She will talk a little bit later on about why American Express partnered with us and some of their objectives with the study. Today, I'm going to spend the first couple minutes providing some overview and context and putting this into context for everyone. And then Denise will spend a few minutes talking about why American Express partnered with us and sponsored the study. And then the majority of the time will be Eliza Gutman sharing the findings and bringing the study to life for you all. We hope to spend a few minutes at the end of the webinar with answering questions. So if you have any, please use that chat function or the question function on the webinar tool. For those of you who aren't familiar, CFSI is the authority on consumer financial health. We lead a network of financial service innovators that are committed to improving the financial health of all Americans, with a focus on those who are struggling and underserved. At CFSI, we've been really interested in this shift recently from wealth to health. When we think about the American dream, we often think about prosperity and upward mobility. But increasingly, Americans' interest has been focusing on financial stability. Pew recently found that the overwhelming majority of Americans, 92%, indicated that financial stability is more important to them than moving up the economic ladder, the income ladder. American Express also commissioned a study, the Life Twist study, and they asked consumers about contributors to having a successful life. Having a lot of money was 20th on a list of 22 contributors to having a successful life. So if wealth is about how much money you have, health is about what you do with that. This has been a decade-long shift. Actually, the last 2 decades, we've seen a shift from health, from this focus on wealth to health. So in recognition of this shift, thinking about the crisis over the last several years, with our focus on financial health, we at CFSI wanted additional data, and so we're really excited to be able to bring the study results with you today. Now you might be wondering, financial health, what do we mean by financial health? Financial health comes about when your daily systems help you build resilience and pursue opportunities. Resilience. Are you prepared for the unexpected? Can you weather shocks? Opportunity. Are you able to pursue your financial aspirations? And day to day, do your financial products and services and the activities you do every day support resilience and opportunity? One thing you'll hear me talk about in just a few minutes is that achieving financial health requires a broad ecosystem of providers, of individuals themselves, of nonprofits, policymakers, financial technology companies. But first I want to tell you a little bit more about our goals from the study. So CFSI has a reputation for having deep consumer insights. We've done a lot of research over the last several years, both quantitative and qualitative. We're partners in the financial diaries and get really excited about those deep consumer insights. So we wanted more data. We wanted to update our data on consumers' use of financial products and services, see what's the same and what's changed. We wanted to assess the current state of financial health in America. And we wanted to understand the interplay between financial health and financial products and services. This consumer financial health study is foundational research for us at CFSI. And it's just the first step in more research, metrics, more tools to help you as members and participants in CFSI's network to be able to help improve the financial health of your consumers. So as I mentioned, financial health requires a broad ecosystem. There's a role for policymakers, for nonprofits, for vendors and solution providers, for technology companies. I want to spend just a minute talking about the opportunity for providers. Earlier this week at the CBA Live conference, the Consumer Bankers Association conference in Orlando, Florida, Gallup presented some data. And Gallup was talking about what people want from their financial companies. And people expect and want the financial institutions with whom they work to help them improve their financial lives. Shockingly, only 9% of people think that their financial providers help them improve their financial life. So there is a huge opportunity here for companies to understand the challenges consumers face, to look at the products they're currently using, what they want to be using, what consumers' goals are, and to help create high-quality products and strategies and solutions that help people improve their financial health. We're really pleased today to be at this point to be sharing more information with you on our financial health study. We couldn't have done this study alone. We have 3 important partners and funders and sponsors as part of this: American Express, the Ford Foundation, and the MetLife Foundation. I'm going to turn it over to Denise Lienhardt to share a little bit about American Express's objectives with being participants in this study with us. Denise?
Thank you so much for handing it over, and I know that we have a lot of material to get through, so I will definitely be brief. But in terms of American Express's interest in the study, we participated in this study to better understand how our consumers are managing their financial lives. And with this research and this data, we hope to take these insights and develop new tools and capabilities to help customers understand how they're spending and saving their money. Thank you again for letting us participate, and we look forward to continuing the discussion.
Thanks a lot, Denise. And now, Eliza, we really look forward to hearing from you about these study findings.
Great. Thanks so much, everyone. I'll start with a little bit about the survey itself, just to provide a little bit of context we're looking at here. So it was a long survey. We deployed it in 2 halves to cover everything that we wanted to cover. And you'll see that we covered a range of topics from ownership and use of financial products and services to all the way to the typical demographic information. So in between, we have the financial health indicators. Kimberly mentioned our definition of financial health. Along with the definition, we developed a list of indicators. So we wanted to really think through what would be an indication that somebody is healthy or not, and where they fall along that spectrum of financial health. And so we have this list of indicators corresponding to each element of financial health, and that really drove the development of the survey in this area, the questions that we asked in this area. And we'll see that as we go through some of the data. You'll see these indicators pop up. We also asked about attitudes. We wanted to know how risk-averse people were, how stressed they were about their finances, how confident they were that they could meet their goals. And we also asked about attitudes towards technology, towards different provider fees, and attitudes about loyalty. So we have the behaviors, the attitudes, the products, as well as the demographics. And we had a combination of objective and subjective measures. So we had the objective, how much income do you earn, how much savings do you have, retirement versus non-retirement, et cetera. And then we also had this subjective, how you're feeling about it, what are you doing on a day-to-day basis. So we have that combination of data in the survey itself. The survey was deployed last summer. Our sample size was slightly over 7,000 consumers, and all the data that we're looking at today and that you'll see in the paper was weighted to the general population, so it's nationally representative. It was deployed online, and we'll talk more about the financial health segmentation. So let's jump in. So first key takeaway is that more than half of the U.S. population is struggling financially. And this finding really comes from the segmentation. So we wanted to take all of this data that we have and find a way to cluster consumer groups and really sort of tease out these different segments that we were seeing. And so to do this, we had to select a subset of variables or questions to put into the segmentation model. And we did that in the following way. We said, well, we want anything that goes into the model to be emblematic of the core elements of financial health. So we want to include indicators corresponding with day-to-day activity, corresponding with resilience, and then corresponding with opportunity. Anything that went in the model had to provide strong consumer differentiation. We had to see lots of differences in the data. And then finally, there had to be questions that were asked to the entire sample. There were some questions that were only asked to a subset of the sample because we had skip logic. So you, for example, you only saw the credit card questions if you owned a credit card. So those were not eligible to be included as drivers of the model. But anything that was asked to 100% of the sample was eligible. So we had a subset of questions that fit those 3 criteria. That subset is available in the paper. And the segmentation that emerged was this 7-segment solution that you see on the screen before you. So our segments go from thriving on the left to at-risk on the right. And we've grouped them into 3 tiers. 3 segments in the healthy tier, 2 segments in coping, 2 segments in vulnerable. And in aggregate, the coping and vulnerable segments account for 57% of the U.S. adult population, which is approximately 138 million people who are struggling financially. So for the rest of the slides, we're really going to delve into these segments. And we'll start with some quick snapshots. So if we start with our healthy segments, we'll just talk about how they really strongly differentiate from one another as well as from the other segments. And with the thriving segment, this is our segment that is most confident in their ability to achieve their short-term and long-term financial goals, and they're most satisfied with their financial condition. And we see that in the objective data, the assets that they have and their level of indebtedness, they have good reason to be this confident. Then when we look at our focus segment, what differentiates them is how long-term they're thinking about saving for the future. So 100% of them, in a very significant proportion subset of that, are thinking, 100% say they're thinking 5 years or more is their most important time frame for thinking about saving for the future. And there's a large subset of that who are thinking 10 years or more. So they're really thinking long-term about their future and saving for the future. In contrast, the stable segment is much more short-term thinking. So 0% say their most important time frame for saving for the future is 5 years or more. And this is consistent with the groups that we see within the stable segment. We have a significant subset that are retirees, and we also have a significant subset that are students, right? So demographically, these subsets are quite different, and yet their behaviors and attitudes are similar, which is how they end up in the same segment. So as I mentioned, what went into the segmentation was a combination of behaviors and attitudes. And then afterward, we looked at how do these segments look demographically. And so that's what we have at the bottom of the slide here. We can see that while the thriving and stable segments skew older and skew towards, and we have significant populations of retirees, we also have a significant amount of diversity demographically within these segments. You know, while we have our retirees and our thriving and stable segments, we also see that about half of those segments are still working. And so we wanted to sort of talk about this, what differentiates them behaviorally, and also make the point that we're seeing quite a bit of diversity demographically within these segments. So let's talk about the coping segments. Here we have in our striving segment, they are most distinct for their planning ahead for large irregular expenses. 100% of this segment says that they do that. They also have a high rate of budgeting, higher than any of the other segments. So this really makes them stand out for this discipline they have about planning ahead and budgeting. In contrast, the tenuous segment, there are non-planners. So 0% of them plan ahead for large irregular expenses, and they have a pretty low rate of budgeting as well. Both segments have high debt loads, and they also have above average incidence rates of having children under 18 in the household. And you see that our age distribution here for these segments is much more even. We skew a little bit younger than we did in the healthy segments. And we have over 60% of both segments working. So now let's move to our vulnerable segment. We'll start with the unengaged segment. And what really differentiates them is the frequency with which they answer, I don't know, to many of the questions that we asked in this survey. So I'll just give you a few examples. Over 60% didn't know how long the household could make ends meet in the event of a sudden drop in income. About a third didn't know where they would turn to get $600 if they had a week to pay for an emergency expense. And about a fifth didn't know whether their household had a budget or whether the household, how often the household ran out of money before the end of the month in the past year. So this really makes them stand apart. In contrast, the at-risk segment is really our, they're in the worst shape of all of our segments. They're in a very precarious financial situation. And just a couple of examples here, a little bit more of a quarter could only make ends meet for a week or less if they had a sudden drop in income. They don't have very much slack at all. And they're more than twice as likely than any other segment to say that they frequently juggle their bill. They also have a very high debt load, whereas our unengaged segment has a lower debt load than the at-risk and then also the coping segment. So before we proceed with some more demographic information about this segment, we'll pause here for a poll. And I'd like for you to take a guess. What would you expect to see? Are you more likely to be working if you're a member of the unengaged segment or if you're a member of the at-risk segment? Who do you think has a higher employment rate? And you should see the poll coming up on your screen. Select your answer. We'll give you a few seconds here. All right. Has everyone put in their answers? Have you taken a guess? What do you expect to see in terms of employment between the unengaged and the at-risk segments? All right. So it looks like you guessed you're more likely to be employed if you're at the unrisk segment. And you are correct. We have such a smart audience here, or you all did your homework and read the report in advance. But either way, you are correct. So what we see here is that more than 50% of the at-risk segment is working, and the unengaged segment is 38% are working. And we see this high rate of not working, not because they're retired. And so what falls into that category is either being laid off or looking for work or being disabled or being a student. And in fact, we actually see our largest incidence rate of full-time students falling into the unengaged segment. About 14% of the unengaged segment are students. One more data point I'll mention before we leave this slide. The at-risk segment, 40% have children under 18 in the household. So that is our largest percentage of any segment. So let's look at some more indicators. Now we have a high-level picture of who the segments are. Let's continue getting to know them by looking at other indicators. We saw a remarkable amount of consistency across indicators, across the elements of financial health. So what do I mean by that? On this slide, you see this heat map. And it's less important, the indicators or the numbers. The point of this slide is really to show you the patterns in the colors. So we have a list of positive indicators of financial health in all three of our categories. And closer to 100% saying, yes, I do this behavior or I'm in this situation, 100% is dark green and 0% is red. And so what you see is in the healthy columns, we have all this green and a little bit of yellow. And then in the middle columns in the coping segments, we move more into the sort of orange-yellow range, a little bit of green. And then as we move to the right into the vulnerable segments, we see oranges and red. And so we see this pattern consistently across the core elements of financial health. Now, we don't see, 100%. There isn't, 100% of everyone in this segment says yes to every indicator, right? They're indicators. They're exactly that. And it's a combination of these things that gives us a sense of somebody's overall financial health. And so we do see a few exceptions. We have the 100%, 0% dichotomies in a couple of places that we mentioned previously. And then we also see, particularly with budgeting, we see this line, this budgeting line really is such an outlier, such an exception to the overall trend, and we'll talk about that a little bit more. But another thing I want to point out before we leave this slide is if you look, it's not only, we go from green to orange and yellow to red. It's not terribly gradual. But if you look at a lot of these, what you see is we have these cliffs. We have these stepwise changes. If you look at that, sort of that middle row, the I'm very or somewhat confident I could come up with $2,000 if an unexpected need arose in the next month. If you look at that row, you see almost everybody in the healthy segment says, yes, I'm confident. You have almost 100% across the board. Then that drops by about half when we get into the coping segments, right? We're in that like 50% range there. And then it drops again significantly when we move into the vulnerable segments with 31% in unengaged and only 4% of at-risk. So we're really seeing very significant stepwise changes between these tiers. So we see that here as we look at some day-to-day indicators. We see this trend hold, and we see the significant drops amongst these indicators. Now, this is a subset of the indicators of day-to-day, and we see this trend very consistently. But let's look at some of the exceptions that we mentioned earlier. So planning ahead for large irregular expenses. We talked about striving, doing this at 100%, tenuous at 0%. But this wasn't a binary question. It wasn't yes or no. Those were options, yes. But what you see here in this chart is that there was also some middle ground here. So in the healthy segments, we see a lot of planning activity. That's that blue bar. But then we also see this green bar start to come through. And this is, we don't need to plan ahead because we always have enough money in the bank, right? We always have a lot of slack. Now, this could be because they're making a lot more than they're spending. It could also be that they're making choices about how to spend so that the slack exists, right? And then we have, in the tenuous, unengaged, and at-risk segments, we see this red bar start to appear. We would plan ahead if we could, right? So it suggests that there's some desire to plan, but either they don't have the slack, or they don't have the tools, or they don't have the know-how. But something is preventing them, is making it harder for them to do that planning. We also see in the budgeting that striving, we mentioned before, has the highest rate of budgeting. And we see this interesting trend here where thriving and at-risk, at opposite ends of the spectrum, they're coming in at roughly the same incidence rate of budgeting. And so it may be that some of the healthier segments feel like they may not need to, for the same reason they may not need to plan. And for the other segments, it may be difficult to budget and plan if it's very difficult for them to predict their monthly income. This is something we saw in the U.S. financial diaries, and we're seeing here in this data as well. We asked consumers, how easy or difficult is it for you to predict your monthly income? And what we saw was, as you move from left to right, you see that easy line, that blue line, the slope, it's sloping downward, right? It's becoming more, and the orange line is sloping upward. So we're having a more difficult time predicting monthly income as we move from left to right, which may also impact how easy it is to do some of these other behaviors. So as we move into the resilience indicators, we see similar trends as we saw in the day-to-day in terms of the changes or the sloping lines. A couple notes I want to make on the resilience indicators. We see less of a drop in the insurance coverage between the healthy and coping segments, which is great. A little caveat to this is we asked whether at least one person in the household was covered by health insurance, by life insurance. So we don't have data on the number of people who are covered or how appropriate the coverage is, but we have at least an initial indication about availability of insurance. And for resilience, it's more about, being able to weather financial shocks and ups and downs is not only about how much you have in a bank account, but also what other resources are at your disposal. Do you have access to affordable low-cost credit? Do you have access to insurance? Do you have access to a network, friends, family, that could perhaps pitch in and help you in an emergency? Are you aware of social services? Things like all of that plays in. And so our questions, many of our questions were worded to try to account for that, right? Confidence about coming up with a dollar amount. How long could you make ends meet? Not necessarily by paying out of your bank account. Maybe there's other things you do to make ends meet. And so that is all playing into households' ability to be resilient and weather shocks. When we move to indicators of opportunity, we see here similar trends. We see this erratic gray line here, which is the outlook for thinking about saving money for the future. And we see that this orange line is confidence about being able to meet long-term goals for financial security, and we see that downward sloping along with the retirement savings line, which is the green line. So saving habits play a significant role here, and we ask consumers about their regular saving habits. And what we see here is a much higher instance among the healthy segment to save with a plan. And there were 3 answers here that make up this bucket. So one is saving regularly by putting money aside each month. That was the most common answer. So you can think about a regular paycheck withdrawal or something like that. Another answer was saving income from one family member versus spending the other. And then the third option was spending regular income, saving other income. So other income could be something like bonuses or gift money or sort of occasional income that comes in, investments or tax returns, that's not the regular income. So we see that is diminishing, that practice, that habit is diminishing as we move from left to right in our graph. And then we have saving whatever is left over at the end of the month starting to increase as we move to our coping segments, and then not saving, increasing, and really the predominant answer among the at-risk segments. Indebtedness is also a very significant component of one's financial health. And we looked at 2 ratios, only one of which we'll have time to discuss here. But this shows the distribution of non-mortgage debt-to-income ratios. So here we're looking at total outstanding debt in comparison to total annual income. And that 40% mark, that 40% or above, is where we start getting into unhealthy territory. And we see that our coping and vulnerable segments are more indebted than our healthy segments. So we looked at this data, and we looked at this income chart as well, and you can clearly see the correlation between annual income and the segments. And it's not, obviously there are higher income consumers who are in the coping and vulnerable segments and lower income consumers who are in the healthy segments. But we wondered how much of the segmentation was merely a proxy for income. And we really wanted to dig into that to understand that more. And so we did a regression analysis to look at that, to say if you hold everything constant, what is the impact, or what is the predictive power of each demographic variable, income, education, number of kids in the household, et cetera? What's the predictive power of each of those? And what's the predictive power of each of the variables that powered the segmentation? So what's the predictive power in predicting whether somebody falls into a healthy segment or not? And so I'd love to know what your hypothesis is. What are we going to find? What is the strongest predictor of being in a healthy segment? We will open another poll here. Do you think it's income? Do you think it's education? Is it planning ahead for large expenses? Or is it having a planned saving habit? What would be your guess about the strongest predictor of being in a healthy segment? I'll give you a few more seconds here to choose, make your selection. Do we have the results of the poll? All right. So 17% thought it was income, 20% thought it was education, another 17% thought it was planning ahead, and 46% thought it was savings habit. Wow. So in fact, what we found was, while income plays a significant role in financial health, which is intuitive, we found that the consumer behaviors, particularly those relating to planning ahead and saving, also have a very significant impact on consumers' financial health segment as we defined them. So let's look at the actual data here. We found that households that plan ahead to make sure they have the money available to pay for large irregular expenses are 10 times more likely to be in a healthy segment than those who cannot or do not. So those who said we would if we could, or those who don't plan. Then when we move to the savings habit, we found that those with a planned savings habit were 4 times more likely to be in a healthy segment. And then we found the predictive power of income and education and other demographics was significant, but had less predictive power. Now, clearly, some of these behaviors are going to be easier with the more income you have. But what we found was when we broke up the healthy segments by income quartile, we found that even across income quartiles, high income, low income, they were engaging in these behaviors at similar rates. So what does this mean, right? So this means that, or it suggests that there's an opportunity to improve financial health with adoption of these behaviors, irrespective of a change in income. Which leads us to our fourth key takeaway, which is that we think there's a massive opportunity for the financial services community here. Whether it's policymakers or nonprofit organizations or financial institutions, there's a real opportunity to help consumers adopt and sustain these behaviors to help them improve their financial health. So we now have these clusters. The segmentation really highlights distinct clusters of consumer behaviors. And understanding those behaviors and attitudes and understanding the pain points and how consumers currently use financial products provides a foundation for thinking about how to improve products and services and help consumers boost their financial health. So we don't have time today to look at all of the product data, but we'll start to look at some of it here. And what we see is that consumers in the healthy segments own checking accounts, savings accounts, and credit cards at higher rates than those who are not in the healthy segment. So similar to the FDIC, we found that 7% of our sample was unbanked, 25% of our sample was underbanked. And when we look at by segment, what we find is a third, nearly a third of the coping segments, the striving and tenure segments, are underbanked. So they own checking and savings accounts, but they're also using other non-bank financial services. And 44% of the at-risk segment is also underbanked. So even though consumers own products, though, we see that they aren't always engaging in these behaviors that we see the healthy segment engaging in. So I'll give you a few examples of that. So 74% of consumers have savings accounts, and yet we see more than half of them not having a planned saving habit, and more than 40% are not confident they can meet their short-term savings goals. Another example, we see consumers, 64% say they have excellent or good credit. Generally, their perceptions are pretty good. It's a topic for another paper, but nonetheless, when we ask them how confident are you can come up with $2,000 if you have an emergency, more than 20% are only slightly or not at all confident. We see consumers with checking accounts paying to cash checks at stores. We see consumers with direct deposit, juggling bill payments. So we see, despite the ownership of some of these products, we see some real pain points for consumers, which in turn highlights the opportunity for the provider community. We believe high-quality financial products and services can help consumers improve their financial health, can help them adopt these behaviors to transact, save, borrow, and plan, and create improved outcomes for consumers. So this is a win for consumers, but simultaneously a win for providers, right? It's an opportunity to acquire new customers, boost satisfaction and retention, and over time, really develop long-term relationships and profitable relationships. We see that consumers are quite loyal. 63% say once they have a product or service they like, they don't like to switch. And so that's a tremendous opportunity for providers to think about how to gain a competitive advantage and differentiate themselves by really focusing on how to improve those consumer outcomes. So what's next? We were unable to cram all of the great data that we have and all of these learnings into one paper. So we will be releasing additional briefs and insights from this data set, from the Consumer Financial Health Study. We're also undertaking an initiative to develop financial health metrics to help the financial services community measure consumer outcomes. So, in order to promote financial health, we need to be able to measure it. And so that is an initiative that we are working on now as well. We'll also be looking at specific products and services and really testing what's the functionality and the features that really help move the needle on financial health. And finally, we'll be exploring the connection between improved consumer outcomes and provider profitability. So with that, I think we have ample time for Q&A. So I will turn it over to Kimberly to moderate our Q&A session.
Thank you, Eliza, and thanks for all of your fantastic work on this study. You've really been a key driver here, and we really, really appreciate your efforts as well in sharing what you've learned with all of us. Denise, I'm going to ask you the first question. So Denise Lienhard from American Express has been a key partner and also very hard worker on this study. Denise, can you say a little bit about how American Express intends to use or apply the information and insights you've gained from this consumer financial health study?
Sure, and thank you again, Kimberly. So we definitely are focused on using this research in this study in order to develop new tools and capabilities to help customers understand how they're spending and saving their money, specifically on some of our prepaid products such as Serve. In the last year alone, we've actually added a suite of features to the American Express Serve product, which actually allow people to save their money, to be able to put it aside into a separate pocket of their spending balance, as well as have launched a feature to be able to track your expenses. And we hope to continue to leverage this research in order to continue to build out those types of robust features and capabilities to really help promote financial healthiness.
Excellent. And Denise, I've been asked a lot this week what some of the most surprising or interesting findings were. You've had a little bit more time to look at this data than people who might be hearing it today for the first time. What are some of the interesting or surprising findings from your perspective? Or is there one you want to share with the group?
Sure. I mean, I think for myself, I think I defaulted into this perception that people at higher income ranges would automatically be more healthy financially, but that actually isn't necessarily the case. And so what's so interesting to me is that people can actually improve their financial health even if their income doesn't change. And healthy finances are actually tied directly to long-term consistent savings plans, much more so than they are to income. So I think that was one of the most fascinating things for me to see, because I actually think that if you provide the right tools and capabilities to help people plan for savings, that they can actually start to drive their financial health.
Excellent. Aliza, I didn't prepare you for this. Do you have any most surprising or most interesting findings that you want to underscore right now?
Sure. So I agree with Denise. And one that I'll add to that, I was surprised at the number of people who didn't know how long they could make ends meet in an emergency. Surprised and a little concerned. I believe for the full sample, it was a little over a fifth didn't know how long they could make ends meet. And so that, to me, spoke a little bit about awareness of financial circumstances, preparation for an emergency, and that surprised me. That was higher than I would have expected for the population as a whole.
Mm-hmm. We have a number of questions about this planning ahead and having a saving habit and how long you can make ends meet that I'll come back to in just a minute. We also have a number of questions about the segments. And so one question, I'm going to give you two, Aliza. So one question is, were the segments defined before the data was analyzed or after? And then the other is, how sharp were differences between the segments? Is there anything else that you can touch on with that?
Sure. So were the segments defined before or after data analysis? So before, to a certain degree. So let me explain what I mean by that. So we deployed the survey, and then we said, okay, we want to do a segmentation about financial health. What should we throw into the algorithm, essentially, right? And so we went looking for, first we said, okay, here are all the questions corresponding with the indicators of financial health. And then in order to whittle them down further, because there's a limit to how much you can put into an algorithm like that, or at least that's the best practice, then we went and looked at the differentiation we were seeing in some of those questions. So I don't know if you would call that analysis. I mean, we were certainly looking at the data to see where are we seeing the sharpest differences, and let's put those questions in the model. But we didn't know. I mean, when we put the data into that algorithm, we had no idea what segments were going to fall out. And so we were, these are the segments that fell out of that model, so to speak. And then we started really looking at, okay, so how are they different from one another? What are we seeing in terms of trends demographically, in terms of product usage, and really starting to learn about who these segments are, how they're similar, how they're different, and and then of course, what does the data look like for the entire sample? So the majority of the analysis occurred after the segmentation was done. Hopefully, I answered that question. In terms of differentiating, I mean, so in those snapshot slides, really tried to call out what are the things that really stand out about these segments. They certainly have many other differences, perhaps more slight. And we really call that the most extreme differences. The striving and tenuous segments tend to be the most similar, with the exception of the planning behavior. Tenuous is a little less confident, Otherwise, they're very, very similar. Whereas, the unengaged has this uniqueness about the lack of, awareness, for lack of a better word, about the financial situation that they're in. And then the at-risk is obviously in a very precarious situation and is very different from the other segments. Based upon, that precariousness, we see pretty much consistently across all of the indicators. So it's, you could take one indicator and say, they have this % versus that, but it's more the combination of all of the indicators together really painting that picture, right? They have one of the highest indebtedness rates, they have very little savings, and they're really struggling. They're really living paycheck to paycheck. There's not much cushion. They're really struggling. And all of the indicators come together to paint that picture of them in that state. Hopefully that, I don't know, hopefully that helps.
That was really useful, Lisa. So I teed up this, you talked a lot about planning ahead for irregular expenses and having a planned saving habit. Can you talk a little bit more about if there's any interplay between those? One of the questions was, does one come before the other? So is this a chicken and egg? Or is one the driver? Was there anything else you found, or the study found, about those different behaviors?
That's interesting. We can't make any conclusions about sequencing, right? Or even cause and effect. This is all correlation, not causation, as statistics professors would love to say. Some of our follow-on work, I think there's an opportunity to do some additional work thinking about, can we get to causation or understand that a little bit more. So a lot of it is inference about the data. They were two separate questions. I really think of planning ahead for large irregular expenses as planning ahead for the foreseen, right? So I know, and the question wording plays into this. The examples we gave in the question wording were things like lumpy expenses, right? Car registration, insurance payment, things are going to come, maybe tax bills, right? But they're lumpy, right? They're not going to be distributed evenly month to month. That's really planning for foreseen expenses, which is different from planning for unforeseen expenses. And I think some of the savings behavior is linked to that latter group, right? So when you're saving, we just said saving habits. We didn't say saving habit for a particular thing, right? We had a different question about reasons for saving. But the saving habit question was just in general, what are your habits, right? And in those habits, if you're putting money away regularly every month, you could be saving for unforeseen expenses, that sort of emergency type scenario. You could also be saving for planned expenses. Maybe your child's birthday is coming up or what have you, you want to take a vacation. You could also be planning for saving for the long term. So in some ways, saving habits, we group these indicators according to these core elements of financial health, but the more I think about them, the more I think, gosh, these things are so intertwined. It's very, very difficult to say saving habit goes in the opportunity category. It really goes into all three. If you have a planned saving habit, it impacts what you're doing every day, because presumably you're saving on a very regular basis. It impacts your ability to weather those shocks, right? Because that saving can be used for unforeseen expenses. And it also impacts your opportunity, the extent to which you can really seize opportunities and achieve your financial aspirations, because if you're saving regularly, maybe you're saving for education, maybe you're saving for a house, maybe you're saving for retirement, but you're doing it in this planned, regular way. And so to me, that question, there's so many ways or so many things you could be saving for, and it really impacts your entire financial life. So hopefully that helps answer that question. If not, please feel free to ask a follow-up.
Thank you. So one of the things we said we wanted to learn from this study is additional data on consumers' use of financial products and services, and that interplay between financial health and product and service usage.
Yeah.
Can you share a little bit of information about anything we know about products, services, tools, resources that the segments are using and how they're using them?
Yeah, so what we found was that, we looked at that initial chart. So to start, right, basic checking accounts, savings accounts, we see higher ownership rates in the healthy segments, lower ownership rates in the coping and vulnerable segments, although still pretty high in the coping segments, much higher rates of unbanked in the unengaged and the at-risk segments. Credit cards, so much higher rate of credit card ownership in the healthy segments, very low rate of ownership in the unengaged segments, and lower rates in the at-risk segments as well. We did some, we asked for folks who don't own a checking account or don't own a credit card, we did ask for reasons why. And prepaid, we asked why consumers are using prepaid. So I will say, I'll just give credit cards for an example. A much larger percentage of consumers in the unengaged segment who don't own credit cards had never owned one in the past. Hence sort of the unengaged sort of moniker, right? They haven't really engaged fully with a lot in the financial system, right? We see 21% are unbanked, 27% are underbanked. I can't remember the number offhand who don't own credit cards, but it's pretty high, and they haven't owned one before. Whereas in the at-risk segment, we see a high rate who don't own credit cards, but many of them have owned credit cards before. And they've had negative experiences with them. And so we start to see differences there. In terms of other forms of credit, we see borrowing from family and friends increases significantly as you move into the coping and particularly the vulnerable segments. Not as much going on in the healthy segments, but much more going on in the coping and vulnerable segments. We see the healthy segments using more traditional forms of credit, lines of credit, home equity, things like that. And then as we move into the coping and vulnerable segments, we see the rates of using payday loans, pawn loans start to increase as we move into those segments. Let's see. So those are the ones that are top of mind for me. We also did ask about use of different kinds of payment, like favored payment mechanisms. So the extent to which people like to use cash and debit cards, credit cards for just everyday buying things and making payments. And the healthy segments really like credit cards. They get rewards, and so they really like credit cards. The coping segments tend to really like debit cards. And then in the vulnerable segments, we saw a mix. The thing that sort of popped out, unengaged segment uses cash quite a bit. And so that really popped out. If I'm remembering correctly, they had the highest incidence of saying, yes, I use cash, always or very often. And so that was interesting as well.
So a follow-up on that, there are 2 or 3 or more people who are asking about financial guidance or use of planning services. Is there any information about, are people using financial advisors, obtaining financial guidance? Any information on that you can share?
Yes. So I'm not going to remember the data points offhand. We did have a question asking survey respondents whether they sought out different types of guidance or advice. And I believe the time frame we asked about was in the either the last 3 years, the last 5 years. I have to look. And we asked about guidance about taking out a loan or a mortgage. We asked about savings or investment guidance. We asked about guidance regarding insurance, and then also debt counseling. And I would say, just off the top of my head, I remember the overall incidence rates being low. And if I recall correctly, the healthy segments were more apt to use the guidance around investment and savings than the other 6 segments were.
Thank you. So here's a different kind of question. I work with low-income young adults ages 18 to 24 and would love to have my students be able to gauge their financial health to drive learning. Have we thought about into developing a survey or some kind of tool that people could use to gauge their own financial health?
It's a great question.
I thought it was a good question.
It's a great question, and I will say it's possible. We haven't done it yet, but it's possible. And I will also mention that I know the CFPB is in their work on financial well-being is also working towards that. And so I think it's a tremendously good question. We haven't gone that route yet, but we could. And I know it's something. Go ahead, Kimberly. Sorry.
I would add whether CFSI has that on our roadmap or not is useful data, and it could be a place that another organization may want to take that and spark some of their own work. So we're happy to follow up as well. I'm going to ask one last question here in the interest of time. There's a variety of questions, and we're happy to engage offline if we haven't had a chance to get to a burning question that you have. But there's been a couple of questions, too, about smartphone or mobile banking usage. Was there anything about usage of smartphones or mobile banking and how that might change with the segments?
Yes. So we saw that the healthy segments the healthy and coping segments actually have high rates of internet banking use. And then at-risk, sorry, let me back up. Internet banking, right? So presumably PC-based, very popular with the healthy segments and the coping segments. For mobile, we found the striving and tenuous segments have the highest use of mobile banking, as well as focused and at-risk. So very popular in those segments. Unengaged segment is low in both, below average in both. So we're seeing essentially, right, the older segments are favoring internet banking, the sort of younger middle-aged are using both, and then the unengaged segment is using both at lower rates, in part because they're just less engaged with financial services in general. But we asked about internet banking, and then in the mobile, we asked about mobile banking, use of MRDC, remote deposit capture, as well as text alerts and emails from financial institutions. And so we did see some slight variation amongst the segments in that way.
Excellent, Eliza. Well, thank you all for joining us today. Before we wrap up, I just want to make sure you all know that we have our large annual conference coming up in June in Austin, Texas, Emerge Forum. And you'll see down at the bottom of the screen there's a discount code there. So as a thank you for joining our webinar today, we're offering you a discount for attending the exciting Emerge conference. So look forward to helping with any other questions, hearing how you are applying the data and insights from this consumer financial health study that is indeed available online within your institutions. So thank you all.